Why is retirement a multivariable tax problem, not an investment one? Investment returns matter, but taxes decide outcomes. For most of your working life, investment performance feels like the main event. You focus on returns, asset allocation, fees, and market behavior. And to be clear, those things matter. You can't retire successfully without disciplined investing. But somewhere along the path to retirement, the problem fundamentally changes. Quietly, almost invisibly, taxes take over as the primary driver of outcomes. Not because markets stop mattering, but because once you stop earning a paycheck, every dollar you take out interacts with the tax system. And that interaction is rarely simple. Today we're going to talk about why retirement planning is not an investment problem. It's a multivariable tax problem. We'll walk through how Roths, Social Security, capital gains, and Medicare all interact, while pulling one lever often breaks another, and why systems thinking replaces single-move strategies in retirement. And furthermore, we will go over why most investors and advisors optimize for the wrong variable. And the hard part is the wrong variable is different for everyone because of the qualitative factors of everybody's unique retirement. Too many advisors optimize for the amount of money you have left at some arbitrary age, something like you will die with so many millions of dollars at age 90. And while you want to make sure you do not run out of money, ask yourself this question: is dying with millions of dollars you never used the best thing you could do? So we will tackle the tax issues you will face, and then we'll show you how to focus on the qualitative issues that will ensure your money does what you want it to do during retirement. Before we dive into all that, my name is Ryan Knoll, and I'm a certified financial planner and founder of NavWealth Partners, a financial planning firm helping clients nationwide make smart money decisions. Let's get started. Why does the problem change to tax at retirement? During your working years, money flows in one direction. You earn income, you save what's left, you invest for growth. Taxes are relatively straightforward. You pay them on your paycheck, maybe manage deductions, and move on. If you're a business owner, there's a few extra levers you can pull, but those levers typically just end up creating extra cash flow. You move back into the business anyways. Retirement flips that entire equation. There's no paycheck outside of Social Security and a pension if you're lucky enough to have one. Every dollar you spend must come from somewhere, and where it comes from determines how much it's taxed. This is the moment when investment returns stop being the main variable, and tax coordination becomes a constraint. But this setup leads to the illusion that returns solve everything. Many retirees assume if my portfolio performs well, the rest will just work itself out. While that is true to a certain extent, this often leads to retirees taking on more risk, experiencing more volatility, and losing peace of mind during market corrections. Two retirees can earn identical investment returns and end up with vastly different outcomes because of withdrawal sequencing, tax brackets, Medicare premiums, Social Security taxation, and required distributions. At this stage, performance sets the ceiling, but taxes determine how much of that performance you actually get to keep. And this is the premise we take when working with clients. We will get you the returns. That's table stakes. But we will help you keep more through prudent tax planning. So what are the four major tax levers in retirement? Most retirees are unknowingly juggling all four of these major account types with different tax ramifications at once. First, we have traditional retirement accounts and pensions, which are taxed at ordinary income rates. Then there's Roths, which are tax-free, assuming you follow the rules. There's taxable brokerage accounts, which can be tax-free or taxed upward of 30% depending on how many gains you realize and where you live, and government benefit rules such as Social Security and Medicare, which are taxed at different levels and have premiums that spike if you're not careful. Each one follows different rules and they don't operate independently. Let's start with how Roths really work in retirement. Roth accounts are often described as tax-free, which is true, but incomplete. Roth withdrawals themselves don't increase taxable income. However, the absence of Roth income changes how other income is taxed. Using Roth assets can keep Social Security from being taxable, prevent Medicare IRMAA surcharges, allow you to stay in lower marginal brackets, and preserve flexibility in high-income years. But overusing Roths early can also create issues, such as leaving large pre-tax accounts to explode later via required minimum distributions, missing opportunities to smooth income intentionally, and tax losses if you put money into them at the wrong times. The question isn't, are Roths good? It's, when should Roths absorb income pressure? Then there's Social Security, or the hidden tax amplifier. Social Security is one of the most misunderstood tax variables in retirement. Benefits are taxed on provisional income, which includes IRA withdrawals, capital gains, dividends and interest, and other income sources. This creates a strange effect where each additional dollar withdrawn can cause more Social Security to become taxable and a marginal tax rate higher than your stated bracket. This is sometimes called the tax torpedo, but the key takeaway is simpler. Social Security turns ordinary income decisions into multiplier effects, and it does not just affect taxable income. It also affects Medicare premiums and your ability to make strategic Roth conversions and capital gains harvesting. Social Security is more than a guaranteed paycheck. It's one of the single most important decisions in every single retirement. Then there are capital gains, which aren't isolated either. Taxable brokerage accounts feel simple on the surface. Long-term gains are taxed at preferential rates, often 0 or 15%. But those rates depend on total income, not just gains themselves. Selling appreciated assets can push you into higher capital gains brackets, increase Social Security taxation, trigger Medicare premium surcharges, and reduce deductions or credits. Capital gains don't exist in a vacuum. They stack on top of everything else. They also may be taxed at the state level depending on where you live. Residents in California and Minnesota, for example, really feel this effect greatly, as state gains rates can be as high as 10% or more there. Then there's something called the net investment income tax, which is also called the NIIT. And this sneaky little tax is almost 4% on top of your capital gains tax if your investment income is more than $200,000 as a single filer or $250,000 as a married filer. The NIIT is complicated and I have a whole video in and of itself on it. We did it last year and it's called How to Avoid the Net Investment Income Tax. It's worth a listen if you think you might be above those thresholds. I've seen this tax eat up thousands of dollars annually unnecessarily for DIY investors. Having a strategy early in the year will help you minimize this 4% tax come December. Next is Medicare, the delayed penalty system that catches everyone by surprise. Medicare premiums are based on income from 2 years prior. This creates one of the most frustrating dynamics in retirement planning. You can make a perfectly reasonable decision today and be penalized for it years later. Large IRA withdrawals, Roth conversions, or asset sales can quietly increase Medicare premiums long after the original decision is forgotten. This doesn't mean avoiding income. It means planning income intentionally. In fact, people who retire at 63 or 64 typically have a huge shock when their final working year's paycheck increases their Medicare premiums for a year or two, causing them to pay thousands of dollars extra every year. So if you're in that situation, it's important to know that you can contest this with the IRS, which does give exceptions for certain events such as retirements or catastrophic losses. So be sure you ask for that. It can save you thousands of dollars. But furthermore, it's really important to factor this into your plan, because it's another way for the government to get into your pockets if you're not careful. Now, before we jump into how each of these variables interplay with each other, I wanted to thank you for watching the video today. We really appreciate your support and hope you find the content to be very helpful. If you're sitting here thinking, I don't know how exactly I will minimize these burdens in retirement, let's talk. There's a link in the description below where you can schedule a meeting with myself or another advisor on the team. We would be more than happy to show you how our process helps take the stress out of your retirement. After all, you deserve so much more than another advisor telling you how much money you will have when you're gone. You deserve a plan that minimizes your tax overhead, generates returns, and gives you peace of mind. Let's jump back into the video and talk about why pulling one lever breaks another. This is where retirement planning stops being intuitive. Every good move has side effects. Roth conversions reduce future RMDs, but raise current income. Lower income today may increase the income later on. Selling taxable assets reduces future gains, but increases current taxes. And delaying Social Security increases guaranteed income, but increases early withdrawals. You can't evaluate any one decision in isolation. This is why retirees often feel like they're playing financial whack-a-mole. Fix one issue, and another one pops up. And this is why single-move strategies fail in retirement. Most common retirement advice focuses on single moves, such as delaying Social Security, converting to Roth, spending your taxable account first, and reducing portfolio risk. Each of these can be correct or harmful depending on the context. And this is where DIY clients who use planning software like Bolden often get trapped. It's designed to maximize your plan on one single variable, which is great for the accumulation phase, but it's not so great for your golden years. And frankly, it's dangerous. If I had $1 for every time someone said they're using some planning software out there that felt incomplete, I'd have more than enough money to not have to make these videos anymore. They're a great cheap resource, but have dangerous shortfalls when it comes to retirement planning. And they're dangerous because they focus on just single move strategies. Single move strategies assume linear cause and effect. Retirement is not linear. It's interactive. Then there's systems thinking, which looks at how decisions interact over time rather than optimizing for one outcome today. Instead of asking, how do I minimize tax this year? Systems thinking asks, how do I minimize lifetime damage across all tax systems? That requires multi-year modeling, understanding income cliffs, accepting trade-offs, and coordinating withdrawals across accounts. This is why retirement planning feels harder for people who did everything right. They have more levers and more interactions. And it is the same for people at every level of wealth. Don't think that just because you are not at a certain level, these things do not matter to you. In fact, they matter more at lower levels of wealth because paying more in tax and not being invested correctly eats into a smaller nest egg more quickly. At higher levels, these decisions become more complex. And while you do have the added insulation of more dollars to be able to eat those costs, Uncle Sam shouldn't be the one taking them. That should ultimately go to someone or something that you care about, assuming you don't want to spend it all down first. Let's go over a practical example. Consider two retirees with identical portfolios and identical returns. There's retiree A, and he withdraws primarily from IRAs, triggers Social Security taxation, hits Medicare surcharges, and faces large RMDs later on in life. They followed a boilerplate plan that was not customized and frankly was just lazy. They either did not have an advisor who cared or were failed by a planning software. They deserve better and hopefully they get some help before it eats into any more of their money. Then there's retiree B, and she coordinates Roth, taxable, and IRA withdrawals, keeps income within targeted thresholds, uses early years to smooth future taxes, reduces lifetime tax drag, and allows them to focus on the qualitative parts of their plan, giving them peace of mind. This person likely paid lower lifetime taxes, kept Medicare premiums in check, had any leftover money positioned correctly for the next generation, and had a solid estate plan that allowed them to minimize their federal estate tax burden. And while living the retirement lifestyle they wanted. Same investments, same markets, different outcomes. Because one treated retirement as a tax system, not an investment account. So why do investment returns become secondary? Once income begins, returns are still important, but they're no longer the deciding factor. A 1% difference in returns matters far less than poor withdrawal sequencing, excessive required minimum distributions, unplanned Medicare premiums, and tax-inefficient asset allocation. At this stage, after-tax income stability matters more than raw growth. But growth is still important, but achieving growth at the right risk level is what matters the most. What we find is that retirees who focus on the tax side first can be more conservative in their accounts. And as a result, they experience less volatility, which decreases sequence of returns risk, all while having an after-tax rate of return that is equivalent to an investor taking a much more aggressive approach and not optimizing for taxes. And this surprises so many retirees. No one clearly explains this transition. Most education focuses on accumulation. Few people are taught that retirement planning is about coordination, not accumulation, sequencing, not selection, and trade-offs, not rules. So retirees assume they're missing knowledge when they're actually facing a different type of problem, which leads us to the real goal of retirement planning. The goal isn't zero taxes. The goal is predictable, controlled taxes, taxes paid intentionally at the right time and the right amounts, which often leads to better outcomes than avoiding taxes altogether and helps retirees to focus on living instead of market returns. The bottom line here is retirement isn't an investment problem. It's a multivariable tax problem. Roths, Social Security, capital gains, Medicare, and RMDs all interact. Solving one lever often breaks another, and single-move strategies fail because the system is interconnected. The retirees who succeed don't chase perfect returns. They design systems that manage complexity over decades. If you want help turning retirement from a guessing game into a coordinated strategy, that's exactly what my team does here at NavWealth Partners. So if you have questions, we would love to chat. If you aren't ready for that yet, throw this video a like and subscribe. That's the best way to stay in touch as we keep delivering this content weekly. Thank you so much for watching, and as always, make smart money decisions.